people may not consume more, but this is a theoretical proposition that it will happen like this. At the same time, suppose supply moves up. Previous day I was showing supply moving up on the upper line, but it is actually this line. This is the quantity. Supply moves up means quantity of supply moves up. So this is on the right side. That is why I changed the arrow. So supply moving up meaning more quantities are being supplied. Maybe new capacity has been created by new companies or existing companies. They have increased their capacity, so more quantities are available, but demand remains the same. So demand line remains here itself. This is the this is the demand line. This demand line remains the same. So when supply goes up, then more and more commodity or more and more goods are trying to chase the same number of customers. So when supply is more customers, this becomes a buyer's market. Earlier it was a seller's market. When sorry, that comes later. Here demand goes up, this becomes a seller's market. Sellers becomes choosy, meaning more and more people are trying to chase the same quantity because supply remains the same, so price goes up. When more goods chase more less customer or same number of customers, so customers are on the driver's seat, and this is known as buyer's market, meaning buyers call the shot. They dictate the price, that I can buy at this price, I won't buy at whatever price you demand or at the earlier price. So price actually moves down to this level where price and demand, supply and demand intersect. So this becomes the new equilibrium. Similarly, if the supply moves down, say this line, then more people are chasing less number of goods, so automatically price moves up to here, and this becomes the equilibrium, the new supply with the original demand. And then there may be a situation when demand supply both move say up or down or something. That becomes a complex situation. Theoretically this becomes the thing. Okay, now this was to convey that you want to maximize profit. So as to maximize profit, you have to you have three options. What are the options? One is increase the sales, but you cannot increase the sales just like that. By now, looking at this and this and this, you must now realize that if you try to increase the sales, then you are trying to increase the supply. So demands remains the same. You increase the supply, price goes down automatically. So you cannot actually afford to do that. Then there will be no profit if the price goes down. So you have to estimate, if I increase the supply by this amount, how much the price will go down. Am I going to make more profit or same profit or less profit? Depending on that, you have to make a call. So either you increase the supply, or you can actually do a little bit of tweaking on the packaging or quality or something, and then increase the price. Can the market afford that increased price or absorb that increased price? Price for you is cost for them. Can the market absorb that increased cost? If they do, then this is another option to increase profit. And the third option is to reduce the cost of production without sacrificing quality. Can you cut corners, like adopting lean product development method and then lean manufacturing methods, and reduce the cost of production? That way you can improve the profit. But in our discussion, we are trying to increase the volume and make more profit. Let us see whether this is done. The primary hypothesis here, or primary assumption, the primary assumption here is that we can increase the sales without affecting price. This is not tenable in reality, because how much we sell, that will be determined by the market forces, not by us. But then that is an assumption that break-even analysis just is standing on. This is one of the legs on which break-even hypothesis or philosophy or theory, call it anything, that stands. So this is one of the drawback of break-even analysis. Now cost can be bifurcated into two. One is variable and another is fixed. At the same time, cost can also, let me not talk about cost, let us call it expenses. Even though in the books and in many places it is written variable cost, fixed cost, but in reality it is actually expense. So there is a succinct difference between cost and expense. It's not the same word, meaning it's not synonym. Cost and expense. Cost is the money that you incur to buy something, whereas expense is the cost of that portion of the goods that you consume. Whatever you consume, the cost of that is expense, meaning you are expensing it off. Suppose you buy raw material of 100 rupees in a year. So that is the total cost you incur to buy total raw material. But then you don't expense all of the raw material during the year. Suppose out of 100 rupees you spend only 90 rupees worth of inventory or say raw material. So your expenses is 90 rupees, your cost is 100 rupees. So there is a succinct difference. Whatever that is, don't worry about that. You should know what is fixed cost and variable cost, number one, even though they are expenses. And second, there is something called direct cost and indirect cost. So you should remember that these two classification. When we classify cost into direct and indirect, that helps us to cost our product. What is the cost of production of the product? What is the total cost of sales, etc., etc. These are two different terminologies. We'll not get into there. That becomes more complex. So that is one classification when we try to do costing of a product or services. When we estimate the break-even analysis or break-even point, to estimate the break-even point, we classify cost into variable cost and fixed cost. That helps us to understand at what point the total cost will be exactly equal to total sales. That means there is no loss, no profit. You can also do that with taking the whole cost into consideration, but that is going to be more complex. For a simplistic view, if you want to estimate the point at which there will be no loss, no profit, then you have to bifurcate the cost into variable and fixed. Now this is direct cost and indirect cost example. If you are looking at a shirt, whatever you can identify on the shirt, these are all direct cost. If there is something that is hidden, that is not visible on the shirt, then that is indirect cost. The canvas or the cloth that goes into manufacturing the shirt is a direct cost that is highly visible. The buttons are visible. The threads are also somewhat visible. From the canvas, you have prepared the shirt. So somebody has cut it, somebody has stitched that. That is also visible. So all these are direct cost. Now you might have paid some rent. I do not know whether it is your own premises or you have rented out the premise. I do not know. How much is the depreciation? No idea. Salary? No idea. Interest on loan? We have no idea how much you borrowed. All these are indirect expense because it cannot be identified on the chart. Now this was to show you or to help you appreciate that whatever we spend or during the course of the business, we have several kinds of expenses. Whereas, and these are the cash outflow for our business, outflow out of the business. Whereas sales is the only inflow. Therefore, sales has to be much higher compared to all the expenses taken together, aggregate expense. So only then we have some profit. So whenever you just sign a slip to somebody for hiring a taxi or a rickshaw or a bus or a train ticket, you should be mindful that this is the money that is going out and this is to be recovered out of sales. Suppose you buy a computer, you pay 50,000 rupees, fine. But at the back of your mind, it must remain always that I have to recover the cost of computer. Now, this will not be recovered in the form of expense. This will have to be recovered in the form of depreciation. That is how you recover the money that you spend to acquire fixed assets. These were to drive home the point that variable costs are many. So these are all fixed and examples of fixed and variable expenses. So sorry. Yeah. Like this means just to demonstrate that variable cost is directly proportional to the number of units that you produce. I showed you this slide. So this is one shirt, so many buttons and some labor cost, some thread, some cloth, all that together make a shirt. If you want to manufacture 2 shirts, then you need just 2 times of that. You want to manufacture 16 shirts, you need 16 times that. So it is directly proportional to the number of shirts. What are they? They are the cost of the cloth, the cost of the button, cost of the thread, cost of the labor, etc., etc., whatever that have gone in to make this shirt. So these are variable expenses. In our term, this is variable cost. Also, cost and expenses are two very distinctly different terms I already defined. So if 400 rupees is the cost of the canvas, 20 rupees is the button, 10 rupees is thread, 100 rupees is labor cost, that makes you 530 rupees. 400 plus 100, 530 rupees. Now, if you are making 2 shirts, 530 into 2, 16, 530 into 16 rupees. So all these are variable expenses, but remember, even though maintenance has 2 components, for our purpose, we are not in an accounting class. So for our purpose, we will consider them as variable. Insurance also has 2 components. In our case, we'll go by only variable expenses, go as only the variable expenses. Whereas for interest, we'll bifurcate. Interest on fixed asset is fixed cost. Interest on working capital loan is variable expense. Okay, then consumable is variable, packaging is variable, etc. So 530 rupees is the variable cost of one shirt. Now you consume, you incur some consumable expenses of 15 rupees, some packaging for 10 rupees, transportation 20 rupees. The total variable cost becomes 575. Now suppose, sorry, these are supposed to, I define how to make this formula for a variable, sorry, for break-even analysis. So this is the formula. Your quantity to make a profit of P is equal to fixed cost plus profit divided by selling price minus variable cost. Now selling price minus unit variable cost is the contribution per unit. We must remember this. And contribution per unit is nothing but contribution margin. If you multiply that with total number that you produced and sold, that becomes total contribution. Let us move forward. If you are trying to find break-even point, then substitute P is equal to 0. P means profit. Then you get this formula. Q star is equal to fixed cost divided by contribution margin. Why contribution margin? That is nothing but sales minus unit variable cost. Sales, it is not sales, it is selling price. Selling price of unit product minus variable cost per unit is contribution margin. And then we have estimated how many units, etc., etc. This definitely is very clear. Now I brought this slide from the bottom to the top. Revenue is all you have to recover all the expenses. This slide is already there. It's a repetition. Recovery of cost of fixed asset in the form of depreciation. I explained that at the beginning. This is an example you should read at leisure. I don't want to spend more time on this. And this is a fixed cost, variable cost, how this is graphically presented. This is break even. This is loss zone. Red is loss zone. Green is profit zone. Anything that wherever you operate, if you operate at the break even point, you make no profit, no loss. You move forward, produce and sell more, you make more profit. That is it. Margin of safety is beyond break even point. Whatever number of units you are producing and selling, that is margin of safety. So graphically showing here, it is numerically showing you are planning to produce and sell 5,000 unit. We have already seen that break even point is 2822.22. That means 2823. Never write 2822.22 because it is a fixed number. It cannot be fraction. Of course, if I express that in terms of number of kilogram or kilogram, how many kilograms you have to produce, then it should be in decimal points. You should not round it off. Remember this. If you are manufacturing something that can be measured, say 2822.22 kilogram can be measured. So it should remain as such. But if I tell you how many buildings you have to produce, how many cars you have to sell, how many say shirts you have to produce and sell, then fraction doesn't mean anything. So you have to round it off to the next full number. So here, if you are producing 5,000 units, this is the difference between 5,000 and 2823 is the margin of safety. Let us move forward. Okay, assumptions. Perhaps I did not discuss so much. Now, this is very important. Assumptions, some assumptions for and limitations. One is cost cannot be divided into fixed and variable. Can be, that is our assumption, that we can separate variable cost and fixed cost. Linear relation. See, we have drawn everything in linear relation as if it goes straight, but in reality it may not, but we don't care. For our own purpose, it is a necessity that we presume or assume that everything is linear. Sales is linear, then variable cost is linear, fixed cost is linear. Selling price, variable cost per unit and total fixed cost remain constant. In reality, it may not, because there is always economy of scale. Suppose you are manufacturing 10 units, your per unit cost will be very high. Compared to that, if you are manufacturing say 1 lakh unit, your economy of scale will reduce the variable cost, reduce the fixed cost, many things. That is in reality. But here we assume that it will remain constant. Otherwise, we won't be able to move forward. We have to recourse to integration or maybe differential equation to find out the variable cost. Sorry, the break-even point. Relevant range of volume is specified within which assumption hold. That is true. Inventory level is assumed to remain constant, meaning that there is no build-up of inventory. Whatever you buy, the same you convert into finished goods and you sell. Nothing remains unsold, because that is why we say we estimate the break-even point. Sales mix is not changed. Suppose you are manufacturing multiple products, so the relative proportion of different products remains the same throughout the year. Otherwise, your estimation will go haywire. You sell all that you produce, no inventory build-up. Some more assumption. Change in volume of sales does not affect the price of the product, meaning that even if you sell more, you don't give anybody any discount. In reality, if you sell more, you have to really give some discount. Labor cost per unit remains constant. Either estimate BEP for only one product or the sale mix does not change, meaning the relative proportions of the sales remains the same. The same thing told differently. So here it is shown again, margin of safety, etc., etc. This is the margin of safety. Okay, now suppose the variable cost changes per unit. Changes means not changes. I'm sorry. Again, I withdraw. I flip that statement. Suppose you have two business opportunities. In one or between the two, the fixed cost remains the same, whereas the variable cost changes. Suppose this one is the earlier variable cost, meaning for business opportunity 1, this is a variable cost. Business opportunity 2, this is the variable cost. So if you have this kind of a context where the variable cost is different for different businesses, then your break-even point will change from here to there, because this line, the total cost line, what is that? The total cost line will change from here to here. Sorry. The total cost, this is the total cost line previously, this is the new total cost line. So this intersect with sales at this point, this intersects with sales at this point. So this line is, this actually has shifted. I should have, I don't know. Something, forget about that. There's no time for that. I have to run so long. I have been revisiting. So let us move forward fast. I hope you get the point. Now, for this new change, meaning the variable cost has changed from here to here. So earlier the profit zone was cost zone was here on the left and profit zone are here. But look now, the profit zone has enlarged, loss zone has come down because the change in variable cost. Now you can do all permutation combination between two businesses. Here the example shows that earlier distinctly two business proposition. In one business your fixed cost changes upward to this, meaning you are going for automation. For automation your variable cost comes down. Earlier the variable cost curve slope of this compared to the vertical line, this is the slope, or this is the slope of variable cost. Earlier meaning you are working on this, say business number 1, where your fixed cost is low, but then your unit variable cost also, unit variable cost is high because you are applying some labor intensive technology for which the variable cost is high. So unit variable cost is the slope of this line. Unit variable cost is the slope of this line like this. Whereas when you adopt some automation in your businesses, then unit variable cost goes down. The slope of this line goes down, goes down. So that actually, that is a context, and that eventually changes the break-even point. Look at this. These are all, this is the change in variable cost. Earlier it was this, now it has come down. So you move, this line moves up here, becomes total cost, and then the break-even point goes down. It may go up also depending on the fixed cost. Suppose in this particular case the fixed cost is not here, but fixed cost is somewhere here, and your variable cost remains the same. So this becomes the total variable cost. Then instead of here, the break-even point will move here. So it depends on the context. Where is your fixed cost and where is your variable cost? So let me change this, change the color. I hope you understand what I wanted to mean. Suppose you have three business opportunities. One is, this is the fixed cost and this is the variable cost. So this becomes the total cost and this is the fixed cost. Sales remains the same. Now business context 2 or opportunity 2, this becomes the fixed cost, this becomes the fixed cost, and this becomes the variable cost. So this becomes total cost and your break-even point is here. Now suppose for the same business, fixed cost is not this, but fixed cost is this one, the red one, and variable cost remains the same. But then you look, the break-even point is here, where total cost line intersect with the sales line. So it is here. So it depends pretty much on the context. Okay, same thing shown with a different example, and then margin of safety, etc., etc. For your benefit, I have drawn too many diagrams. You can see them. Let us move forward. This also is what is it? Break-even point. So forget about this one. This is a simple example. Now next topic is operating leverage. It's very important. Operating leverage and then cost indifference point are the two new items for today. Sorry. You should understand two things and the distinction between the two. One is operating leverage, another is financial leverage. Leverage is a dictionary word and we use it very frequently. I don't know whether you have used it even once or not, but we use it in business parlance. This is used very extensively. Suppose, suppose you have IIT degree and other people are from different places. Now you are applying for a scholarship abroad. Now someone is asking you that, you know, you have a competitor from so and so college. Now you can say that, okay, I have an IIT degree, he doesn't have. Alternately, you can say, I'm going to leverage on the IIT brand. That is how you leverage, meaning you exploit something for your advantage. Suppose you are applying for a loan in a bank, for education loan or for business loan or whatever. Now suppose your uncle is known to the manager. So you are telling your friend, you know, I am applying for a loan in so and so bank. I am going to leverage my uncle's acquaintance with the manager, or my uncle's network existing in the manager or something. That is how you leverage. In finance particularly, or in business in general, leverage is used slightly differently, but the core philosophy is the same. By now you know balance sheet, profit loss account. You already know what is loan, what is equity. When you estimate the debt equity ratio, the debt is at the numerator, equity is at the denominator. Suppose you have borrowed 50 lakh rupees from bank, and the total equity, which is the aggregate of equity capital and reserves and surplus or other equity, the total of that is suppose 20 lakh or say 25 lakh. So total debt is 50 lakh, total equity is 25 lakh. 50 divided by 25 is 2. So your debt equity ratio is 2. Now suppose you are talking to a friend. He also borrowed from bank maybe 40 lakh rupees, but his total equity is 10 lakhs. So his debt equity ratio is 40 divided by 10, which is nothing but 4. So his debt equity ratio is 4. Now we say that your friend or your friend's company is highly leveraged. Your company is optimally leveraged because your debt equity ratio is 2:1, debt is to equity. Whereas your friend's case, in your friend's case, the debt equity ratio is 4:1, debt to equity. So we call that he is highly leveraged. So companies who raise more debt compared to whatever equity they have, they increase the leverage. So you can say, I can increase the leverage because I am at a very comfortable level. Suppose your debt equity ratio is 1:1, meaning whatever is your debt, that much is your equity. So 1:1. Now you can say that, I can increase the leverage a little bit and raise some money from the bank and go for an expansion. That is how leverage is usually used. Now, there is another term in leverage that is known as operating leverage. Almost similar, but on a different context. Excuse me for a second. Sorry. Operating leverage is on an operational level, you can leverage. Suppose your variable cost is quite low compared to your fixed cost. There will be one point when for every incremental or marginal unit of sale, every incremental sale, your profit will be significant compared to a context where your variable cost is high compared to fixed cost. I will explain that with examples moving forward, but try to understand when your variable cost is low, suppose you have two businesses. Suppose you have two business propositions before you. In one particular business proposition, the variable cost is X1 or V1. In another, it is V2. Now compared to their fixed cost, suppose in one case out of the two, the variable cost is significantly low. What does it mean? I'll show you later. But what does it actually indicate? Let us understand. Suppose out of the two business contexts, in one business context, the variable cost is quite low compared to the other businesses. Wherever the variable cost is low, we call it, we have significant operating leverage, meaning we can leverage on our operation. Leverage is always a good thing. Leverage is always a good thing, but when you leverage it too much, in case of finance, you raise more loan. Why good thing? You can walk into a bank and raise loan, but eventually it may or may not translate into profit. You know, at some point there are contexts when you need more money to increase your capacity and you make more profit because you earn more money than the interest that you pay. That may not be always feasible. But in case of operating leverage, the same thing applies. The term but is not applicable. I'm sorry. Meaning in case of operating leverage also the same thing applies. If you are operating at a point above break-even point, for every unit you make profit. Wherever variable cost is less, you make more profit compared to wherever variable cost is more. Let me show it with graphically. I think I have another graph. I have drawn it today. Yeah, just now I have drawn this to explain you. Suppose you have two business propositions. I did not label it because the time was short, but before sharing, I'll label. I will remove my earlier slide deck from Microsoft Teams and I'll put this one. Look at these different lines. Say these two are different business propositions. Let me label it right now. See, this is fixed cost number one. Say this one. The text. Fixed cost one is this one, and fixed cost two is this one. Just a second, since I came out of it. Let me take the attendance. Okay, now suppose this is fixed cost 2, this is fixed cost 1, and this is again, let me come there, and suppose this is variable cost 1 and this is variable cost 2. It's not variable cost, it is total cost, but I'm writing variable cost because okay, variable cost is same here. So this is variable cost 2. This is variable cost 1. Let us not talk about 2 at all. And this is total cost 1. Okay. Now variable cost has not changed. This is the scenario. Just try to remember this. And okay, let me copy all of that. It will be a better idea. Let us move to the next one. Now, this is variable cost 1 and this is variable cost 2 here, meaning total cost, not variable cost. Forget about. Okay, let me pull it down here. So this is variable cost 2. This is total cost 2. This is total cost 1. Okay, I hope you understand now. Sorry, this is getting cluttered. See, this is the fixed cost 1, this is variable cost 1, so this becomes the total cost 1. This is variable cost 2, this is, oh, I didn't change the, I thought I changed the fixed cost. Good God, this line should come there. So this variable cost is actually here and total cost is actually here. So this comes here. Now I think it's complete. What I want you to appreciate is, look at this one. As I said, the angle between the two is the contribution. Here the contribution is more compared to this. This is the contribution. The break-even is reached much later. I don't know if it is looking slightly complicated. I'll offer you the tutorial class when I'll be explain this even more elaborately. But there are very smart students. I don't want them to waste their time, so they may not attend the tutorial. But if anybody needs further clarification, they should attend the tutorial. We'll be discussing more about this. I'll start drawing from 0 and then move forward slightly slowly. So total cost 1 is this one. Total cost 2. Oh, sorry. Total cost 2 is this one. Total cost 1 is this one. And this is the sales or revenue. Variable cost 1. Sorry, this is not variable cost. This is sales. This is variable cost 1. Okay. I don't know if I've made this mistake here. This is actually sales. The green one is sales. Okay. Now let us move forward. This is another example showing the same thing. Here the fixed cost moves up from here to here. The variable cost was here. The variable cost moves up to here, meaning it becomes lower. And then this line shows the contribution. Here the contribution is more. And if you remember, contribution is the profit that you make post break-even point. Post break-even point, for every single unit of sales, it is the contribution that translates into profit. Okay. I think that should be good enough explanation. Now, this is a slightly complex example of showing the degree of operating leverage. Just now I prepared this. So in my earlier shared document, this slide is not there. So don't download that slide. Download the slides only today after I upload this. So this is a simpler example. After you read this, then you move backward, or maybe I'll put it here. So this comes first, then you move to this to understand it some slightly critical. So now we compare between the two options and then we try to see how degrees of operating leverage actually helps us. What is the meaning and what is the benefit? Here we don't change the fixed cost. We don't change the fixed cost between two business opportunities. Between two business opportunities where the variable cost is different, selling price is the same, but fixed cost is the same. Very rare opportunities like that. Obviously, the obvious choice will be that you adopt that where the variable cost is less, because that is directly giving you more profit. But just to drive home the point, I have put this slide. Here, the fixed cost is different. Here it is 2 lakh, here it is 20 lakhs. Similarly, the variable cost is different. Get this? Whereas selling price is the same. Selling price is 25,000 per unit here, 25,000 per unit there. So I have demonstrated how better degrees of operating leverage gives you more profit. What do we mean by higher degrees of operating leverage. So here, suppose you are producing and selling 1000 unit, 1000 unit. Variable cost is 15, variable cost is 20. Annual fixed cost is 20,000, 20,000. Selling price is 40, 40. Now, moving forward, you can see the break-even point. I have not estimated the break-even point, but suppose you are manufacturing 1,000 units, you are making a profit of 5,000 when you sell 20. How many? 1,000 units. Here you don't make any profit because this is the break-even point. But after break-even point, your marginal revenue per unit is 40, marginal revenue per unit is 40. Marginal cost is 15, marginal cost is 20. So marginal profit for every extra unit is 25 here, it is 20 there. So this is always better. Post break even, you are making a profit of 25 rupees per unit, you are making a profit of 20 per unit at this case. Now here, actually I'm now losing energy, so I'll be speaking slightly slowly, maybe softly. So you can see here annual fixed cost is 20 lakh, here fixed cost is less. Sorry. So at the present production, unit fixed cost is irrelevant. So just forget about this part. This should not have been there at all. That you don't have to actually forget about that part. You estimate the marginal revenue here. Marginal cost is 15,000, marginal cost is 20,000. For each extra unit, you make a profit of 10,000, you make a profit of only 5,000. I'll show you a different example. I'll have a third slide here to drive home this point even better. Now, next is cost indifference point. Cost indifference point is that point where there is no difference between two business proposition if you operate at this point. Meaning, if you produce and sell certain quantity, then you don't make a difference in profitability between two businesses, even though the two businesses are very different. Graphically speaking, suppose this graph shows number of unit you produce and sold, this axis, x-axis, and profit that you make in the y-axis. This is not the same graph like this earlier. Here we were showing how many quantity you produce and sell, and this was cost and sales. Now it is very different. It is number of items you sold, that is right, but here it is profit, not cost. It is profit, not cost. So the graph looks like this. For one particular business unit, the profit increases slowly. For another businesses, the profit increases quite fast. Quite fast. This one. Let me put it differently so that, yeah, the profit increases like this. Look at this point. When you produce, say, 2,000 units, you make less profit for this, more profit for that. And when you produce 7,000 units, same thing. You make more profit for the blue line than the red line. The red line represents one business, the blue line represents another business. Whereas at this point, whatever profit you make using the red line, you make the same profit using the blue line. Okay, there is no difference in profit between the two businesses. This point is known as cost indifference point. Now moving beyond this point, look at this. In the businesses representing the red line, they make less profit compared to the blue line. Just converse to whatever you did before the cost indifference point. At cost indifference point, you make same profit, even though your cost structure is different for both, but then your total cost remains the same because you are making same profit at this point. Okay, now moving forward, you make more and more profit for the business represented by the blue line compared to the red line. Now, what is the utility of cost indifference point? Suppose your market situation is such that you don't forecast to sell more than 6,000 units. You forecast that you may make a sales of 6,000 unit, say this one. So if you forecast that your sales will not exceed say 10,000 unit under any circumstance, then remaining in business proposition number red makes all senses because you make more profit using the business represented by the red line than business represented by the blue line. So you remain there. But suppose you think that you are using hardly 50% of your capability, you actually have a capacity to produce and sell maybe 20,000 units. So here, not here, but there, somewhere here. Sorry. Oh, I'm sorry. I don't know what I took up. It's this line. So say 20,000 unit will be somewhere here. Okay. So you are making a profit, better profit using blue line than the red line. So depending on whether you are operating here or you are operating here, you have to take a call which business to adopt. That is what is cost indifference point and how cost indifference points actually helps us. Now here is an example that 10 karat gold jewelry, you estimate the total cost, you estimate the total revenue, and then plot the profitable, or you estimate just using simple formula where cost indifference point, at cost indifference point total cost is equal to means total cost for both the businesses are same. So using that analogy, you can actually estimate, like say this is variable cost per unit is 40, variable cost per unit is 60. Fixed cost for the year is 50,000. Fixed cost for the year is 30,000. This is a good example. Selling price remains the same because it does not depends on your technology. It depends on the market. So that remains same. Here contribution is 60. Here contribution is 40 because 40 rupees is the variable cost, 100 rupees is the selling price. Selling price minus variable cost is the contribution. Now the profit is nothing but sales minus total sales minus fixed cost plus, sorry, beyond break-even point. Beyond break-even point, if we are in the profit zone, then your profit is equal to contribution into number of units that you sell beyond break-even. Let me see what I have done. See, 60 is the contribution multiplied by number of units that you are selling minus fixed cost is the profit. So profit of this business is equal to profit of that business. Here 40 rupees is the contribution multiplied by number of units that you are manufacturing and selling minus fixed cost is the profit. These two profits are same. And same at what point? At cost indifference point. At cost indifference point, you sell the same quantity. So the quantity is equal to, now you bring Q at one place, then Q becomes 1000. So this is the cost indifference point. I hope you understood. There should be no. Now, earlier I talked about fixed and variable cost. I think I showed you that this is the classification of fixed and variable cost. So you can read that. Break-even point is used for many purposes. Most importantly, when you are selecting 2, 3, 4, 5 business, means you are selecting one out of 2, 3, 4, 5 businesses. It provides information on minimum sales for achieving profit under different businesses, for different businesses. Then it helps to compare multiple businesses. It estimates amount of goods to be sold in order to meet all expenses, level of production and profit thereof. Act as a milestone for the entire team to achieve businesses. Just a second. Okay, I cannot do that. Now, level of production and profit thereof act as a milestone to the entire team to achieve targeted sales. Suppose you are talking to your team that, look, we have to produce and sell at least this many quantities in order to produce, in order to break even. So everybody gets a milestone that we must achieve this. Understand the price sensitivity of profit and decide on price, cost control, decide on cost structure and quick estimate, etc. Limitation. We have already discussed. Fixed costs vary with turnover, but we assume that they don't vary. Variable cost may go up and down depending on amount of sales. That is not considered in case of break-even point. Break-even estimation is easy for simple businesses such as one product company. It is difficult for multi-product company, etc., etc. Then of course, we are almost reaching to the end. Advantages outweigh limitations. Though there are many limitations, but the advantages are many and we have no alternative but to adopt this. It is especially helpful for startups in selecting opportunities. Okay. Inventory costs you money, try keeping it low. This is something very different, meaning that if your inventory is high, you will end up borrowing a lot of money, then your cost will go up because interest is a huge cost and that will increase your total, that will reduce the profitability and then it might be different. This you don't have to see. I have put across this on also. This is the takeaway from this class. That is the degree of operating leverage measures the change in operating income of a company in response to change in sales, number of units that you sell. The degree of operating leverage helps analysts gauging the impact of change in sales on earnings. If sales increases, in large measure of a company of high operating leverage, profit increase and vice versa, etc. So you read all this. This is very important. Last line is also important. Degree of operating leverage is exciting for companies operating beyond break-even point, but is damaging for the companies operating below break-even point, because for every unit you produce, you increase the loss, operating loss. 10-carat gold jewelry, again the same estimation based on a different kind of data, or maybe this is a repetition. You have to see conclusion and thank you. You read the conclusion later. I'm running out of time, running out of energy as well. I'm kind of growing too old, I think. I don't know. I never used to feel like this earlier. So thank you very much. I am stopping my sliding, and if there is any question, I'm here. Otherwise, I'll leave the meeting immediately.